In this week's update, no doubt the market character has changed. Is it time for major adjustments? And how to get the big edge? My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is general information only. All right, let's take a look at what has been a pretty tumultuous week, really the second week in a row where that's been the case. And there's no question that we've got markets globally that are in transition from bull markets to, at this stage, we don't know what. Is it going to be a volatile sideways move, or are we actually going to go into some sort of cyclical bear market? Can't say at this stage, but I know very clearly what the signs look like because I've done this dozens and dozens of times before. Now, one of the things that I do know, and this is really just a gut feel impression, but I think it's valid, is that earnings season volatility has risen quite dramatically for stocks where the results were quite okay, or not quite okay, but they were certainly, good enough not to bring 20, 25, 30% in a session kind of volatility in both directions. There has been a huge tussle of opinion between market players on many, many stocks. And I don't recall seeing the severity of that volatility in both directions previously. If you've got a stock that misses and the price goes down 20%, fair enough. That's absolutely normal. But when it goes down 20% and then it bounces 25% and then a couple of days later it's back down again, that is pretty irrational sort of behavior. So is this just Trump-induced uncertainty? Look, I think that's got to be part of it. There's no question that investors now are pretty confused about what comes next and are pretty uncertain. And whenever there is uncertainty, there is downside generally. And then the tussle of opinion sets in. So I think that is certainly part of it. But it's more likely that we've had so many events since August last year when the Fed cut interest rates for the first time, and according to the bond market, unwisely. We then had the election, we then had DeepSeek, we then had Fed comments at the end of December. Everything has been thrown at the market. And I think finally, all the negatives and all the uncertainties have just stacked up enough that it's now getting acknowledged and valuations have had to reset, because it's just the weight of uncertainty. And then we've got some sectors where we're seeing forced liquidation. Not liquidation because it's a valuation reset or because it's some other fundamental reason. It's just the market has to get liquidity from somewhere, or some players in the market have to get liquidity from somewhere. And so they sell things that are liquid. And it's often in this area where you see an actual opportunity, a really, really good opportunity, where a company that shouldn't be sold down is for transient reasons. So that is certainly an interesting opportunity. Now, on Friday, the US market bounced. And again, for Australian-only investors who may not be interested in what happens in the US market, you just have to be interested in what goes on in the US market because it absolutely dictates what happens here. So if you shut off to what's happening there, then you really have no basis to be making decisions in Australia. So that's why I always start with the American market, because it just sets the scene for the rest of the world. So the Friday PCE, which is personal consumption expenditure, which is a key benchmark for the Fed and helps set sentiment. So that certainly was a positive for the market, and the market's bounced. But consumer confidence has taken a big hit, and the CNN Fear and Greed Index is now very firmly in the extreme fear category. That can't be good for stock markets. It never is. So we're in a tricky situation, and that's why the title says markets in transition, because at this stage we don't have enough evidence to say what that transition to is yet, but it will become apparent fairly soon. Now, if we look at the character of the market, it's shifted in multiple ways. Money flows have turned to a degree to defensives. Not dramatically so, but certainly there's been some money flows into defensives. Many stocks, the vast majority of the market, we're starting to see lower peaks and troughs on a short-term basis. Not enough, again, to say that there's been a significant long-term trend change, but enough to be on alert. The multiples are contracting. We're seeing the valuation reset, and the outlook statements are more muted now. That is a result of CEOs being more cautious, and why wouldn't they be in this environment of tariffs coming left, right and centre? It'd be amazing if CEOs had not turned more conservative and were being less rosy about the outlook. But that's certainly a shift. And hopefully you've heeded the messages that I've put out over the last couple of weeks. And just as a reminder, because I saw these changes building up a couple of weeks ago. So this was one of them, the valuation reset, and the other one the week before was that there was a significant market disruption in play. So hopefully you heeded those messages and took whatever steps you needed to take to stay on the right track and to be psychologically comfortable with what the market is doing. So definitely a change in market character. But have we reached the bottom, or are all stocks reacting poorly? And the answer to that is that no, some are still breaking out and looking extremely positive. And I'll show you those charts shortly. So one way of attacking the market is just to really narrow your focus. And I talked about this last week about the fact that you need to move up the valuation scale. And if you look at the stocks that are currently breaking out in America and looking amazingly strong, they are up the quality scale. So that's exactly what's happening. Companies where the market feels very comfortable about future earnings are still being well supported. My approach has always been to use fundamentals, not to get some exact answer to the second decimal place. That's just completely pointless, because markets can and do something completely different. But use fundamentals to get yourself in the right ballpark. Zero in on quality companies that are in a position to continue to grow earnings irrespective of what happens. And then once you've identified those stocks that are in the right ballpark, then the rest is just about reading the money flows. So plenty of charts we're going to be looking at in just a minute. But just before I go to that, of course, as I say every week, it's a lot easier to lose money in the stock market than to make it. Clarity of purpose and discipline is absolutely critical. So you've got to make sure that you've got an accurate perspective and are getting good, solid advice. Let's look at American stocks very quickly, and then I'll get to the charts. The S&P dropped 1%, but the NASDAQ was down 3.5%, so a bad week for particularly the big tech stocks. The Russell was also down 1.5%, which is not disaster territory. But look, this is really telling. And the equal weight S&P, which is the RSP, is the ETF. It actually rose by a tiny amount, but it rose. It didn't get beaten up like all the rest. So that tells you quite a bit about the breadth of the US market. There are still sufficient number of stocks that are holding their ground or are going up to offset the ones that are declining for the equal weight S&P 500 to be roughly flat to slightly higher. So there's a big message there about the likely severity of this corrective phase. We're just not seeing the evidence yet, and I stress yet. Now, Friday night was a reversal. It was okay, but it was nowhere near enough to offset the damage of the last week and a half. So don't get carried away with Friday night's positivity. I have to acknowledge that there are still plenty of stocks that are breaking out, setting new 52-week highs, or are within an absolute whisker of doing so. So things aren't all bad when you see that. And the only way to know that, because you can't get that from the index can, from time to time, be completely misleading according to what's going on under the hood. The only way to do that is to do what I do pretty much every day, but certainly extensively once a week, is just to trawl through 300 odd plus US stock charts, individual stock charts. And that gives you a clear sense of where the money flows are going and what's actually happening in the US market. You don't get that from looking at the index. At this point in time, I've got to err on the cautious side and say that we really should only be expecting a bounce. The path of least resistance is to the downside. It might only be short term and it might only be small. I don't know. But there is enough in what I've seen to certainly move to cautious. And members of the Insiders Club and portfolio analysts know exactly what I'm talking about, because I've been talking about this very specifically for weeks and weeks now. And they have been able to take appropriate actions. The US dollar was higher, 107.5. The 10-year yield eased to 4.2. And we've seen a dramatic shift where you go back to last year and a lower 10-year yield was cheered by the market and stocks went up. In fact, it was almost required for stocks to go up for the yield to fall. Now we're getting the yield falling and stocks are falling at the same time. And the reason, of course, is the market is now, it was very confident last year about the economic position and corporate earnings. It's now seriously thinking that the American economy could deteriorate under the weight of these tariffs and the uncertainty and what it's doing to consumer confidence. So there has been a dramatic shift in the relationship between the 10-year yield and the direction of stocks. And the VIX index has been up in the 20s. It finished the week just under the 20 mark. All right, let's look at some charts now. This is the RSP on a weekly chart. You can see just a very slight rise, but that's a heck of a lot better than the other indices, certainly the NASDAQ. If we look at the S&P, the character has changed. You look at that compared to back here where we had successive highs and lows. We've now gone into a sideways band where we've got equal highs and lows, and we've got key support pretty much where the market was before Friday night. So that's a key support level around about the 58.35 mark. So the character has changed. But we don't know yet. We need more information as to what. Will it continue sideways in a volatile fashion, or will we actually break these support levels and head down? So to shed more light on that, let's look at some other indicators. The first one that I always look at, and I've been tracking this for years and years, is the spread between consumer discretionary, XLY, and consumer staples, XLP. And when the ratio is rising, that means that the market is feeling confident because it's prepared to put more money into more aggressive discretionary stocks and proportionately less money into defensive. So the market feels very positive. When this rolls over, as it did right at the end of 2021, money flows are going more into defensives than they are into the aggressive growth stocks, then this ratio falls, and it falls dramatically. And I haven't changed what's on this chart since 2 or 3 months into 2022. This was the change of character where this ratio rolled over and we started breaking key support levels. We set lows that were below previous peaks. We then got the obligatory bounce that you always get, and then we dropped away. So the speed of this decline, the fact that it fell very sharply, bounced, and then for a very short period of time and then started to fall away again, was very telling. And that was obvious from mid-December of 2021, which I called at the time, and that was before the bottom in the market. In fact, for many stocks and sectors, it was a couple of months before. So that was a very clear early warning signal. It was the first sign of a change of character. And so to start to move to a more defensive mindset was really well and truly on the cards by the end of the year. And the ultimate confirmation really came when we set a new significant swing low, which occurred just here. And that was about the middle of January. And all that had occurred really before most stocks started rolling over. So there was plenty of opportunity to get out of the way. So I'm watching this one very carefully. Now, that was the precursor to pretty much a whole year. So all of 2022, this ratio fell and fell significantly. And when I look at particularly stocks like Amazon and Google and Microsoft, they fell a long way, of the order of 40 to 50%, which is really quite huge. Now let's look at where we are now. We've had a very sharp to the downside in this ratio. So it's very similar to what we saw here in early December 2021. However, what we don't have yet is confirmation that we're going to have a weak bounce and then we're going to break this low. So this is the key to look at right here. The nature of the bounce of this ratio and then whether this low breaks. If that happens, if we get a weak bounce and then that low breaks, then we're in for a deeper and longer correction. So this is an absolutely critical chart that I'm watching. This is somewhat similar. This is the NASDAQ versus the S&P. It's really its growth versus the rest of the market. Nothing much here that's definitive. It's been going sideways. The market has been in equilibrium pretty much all of 2024 and so far in 2025. But it's certainly not that far off some key support levels. We don't want to start breaking this low, for instance. That would be another point of confirmation. Now, just looking at some of the individual stocks. So this is Amazon on a weekly. So this is December 2021. So this is what actually happened to individual stocks, not something that's perhaps a bit of a misrepresentation because of the overall index. So this is December 2021. We had a clear change of character in this period marked by this green bar. So from towards the end of January through to May, there was a very clear change of character. But of course, we did get early warning on this. The ultimate confirmation came when we started breaking these lows here. And then for those that are investing longer term that need even more confirmation, then we got it when we broke this low. And then the market, of course, or the price of Amazon fell quite a long way. And it was actually a 52% decline from peak to trough. That is not something that is pleasant to sit through. Let's look at Google. Very similar setup. Chart looks a little different, but it's very similar setup. And that was the precursor to Google falling 42% from peak to trough. So we're in this transition phase. I'm watching multiple charts and ratios very, very closely. We don't have confirmation yet, but there is certainly enough evidence that you want to have moved into cautionary mode. Now, let's look at some other charts. So this is I'll go to the NASDAQ first. So these changes of character are pretty easy to spot from my perspective because I've been doing it for so many decades. But the hard part is acknowledging them because we've been in a certain mindset for a long period of time. We've been in a very bullish mindset for a long period of time. It's very hard to, first of all, acknowledge what you're seeing, acknowledge that maybe the party is only 2 minutes to midnight and you need to start thinking about grabbing your things and going home. And then the next thing is actually pulling the trigger, because if you've been in a stock for a lengthy period of time and you've done very well out of it, it's actually hard to take the action to get out of it. Or if you're in a stock that you got into too late, you're now a bit underwater, you're loath to get out of it because you were buying it for the long term, but the chart is really telling you that you should. So taking action is also difficult. So this period is not easy. But if you've got a clear process, a process that determines your exits, it's not a gut feel, it's a clear, unequivocal process, then that contributes greatly to confidence because you can just relax and you feel confident about what you're doing. Yeah, the market might go down further. Some of the stocks you own might go down. but they'll come back because the fundamentals and the quality is in the right ballpark. And look, there's more information on our website about all this for anyone that's interested. So just recently, we've had several panic moments in the market. We had one in early August, which was about the Fed cutting rates, and the bond market hated that, thought it was a really bad idea, and the market reacted poorly to it. Then we had, on December 18, we had some more negative rhetoric from the Fed about there wouldn't be nearly as many rate cuts in 2025 as what the market had priced in. And then in early February, we had the DeepSeek episode that really very briefly punctured sentiment. So we've had several panic moments, but members were advised to take no action, that this was just a blip, because I didn't see the entirety of what I've just gone through. The rest of the evidence just wasn't there. This was just a bit of an overreaction blip. Now it's different. I'm seeing enough evidence that we need to do something different. And so within the memberships, we've taken profits and we've taken exits where it's been appropriate. So this is a period that shouldn't be ignored. When we look at semiconductors, they're so important. I always look at this chart every single week. It was certainly a negative week last week, but is it a change of character? I can't say yet that it is. So that's another slight positive, if you like, that semiconductors have not taken an absolute hammering at this point in time. Now, I want to just show a couple of other charts. So we've seen the negativity around Amazon and Google. These are what some of the other charts are showing. And by the way, I haven't seen, one of the reasons that I don't think we're at the bottom yet is that I haven't seen the capitulation that normally goes with a period of valuation reset. It's generally messy and untidy, and there are some significant sell-offs to the downside. Haven't really seen that, where the sentiment gets really negative. And many stocks look like this. Don't worry about what stocks they are. These are just showing charts. But here's MasterCard, held up fantastically well during all the carnage for the Magnificent Seven. And then on Friday, when the market did turn positive, it busted out with some degree of emphasis. So that is a very positive chart. Here's another one. We had a lengthy, this is on a weekly chart, so this was a lengthy period of consolidation and then an emphatic breakout. Look at the volumes. This is the kind of move that you see in full-on bull markets. So the possibilities are still there. Here's another one. But there's almost nothing. I went through my key lists for Australia. There's almost nothing that looks like this at this point in time. The Australian market really is finding it tough going at the moment, that's for sure. And just to finalise on the charts here, this is important. I think most people would want to see what a chart of NVIDIA looks like. Their earnings results by any standard, by any other company standard, were really good. And I think the valuation, from my perspective, is not an issue. But the expectations around NVIDIA were just so great that the market sold off fairly sharply. This is a daily chart. You can see it sold off quite sharply on Thursday before we got a bit of a turnaround. That's NVIDIA. It's not a disaster, but this is a key level. Don't really want to see NVIDIA below 110, and particularly with any sort of momentum. Candles like this, rising volumes like this, that's what you don't want to see. And to make a judgment about where the market is going over the next 6 months, that is why you can't just look at an index chart and be able to make a clear decision. It's just not enough information. To Aussie stocks, the Aussie dollar was down to 61.5, so we'll look at the currencies in just a minute. The ASX 200 was down 1.5% for the week, and it's now 5.2% off the peak in just a couple of weeks. So it's been a significant move in the Australian market. Energy sector has been in decline for 6 months. Materials sector has rolled over. It's been consistently trading below the 200-week moving average now for many weeks. IT had a really poor week, but it's very stock specific. Certainly what stocks like was Tech Global did not help, and we're also getting a valuation reset on stocks like Xero, for instance, some of the really high PE stocks. So poor week for IT, but I don't read that as being part of a new trend. Certainly is for Tech Global, but for some of the others, it's really just a valuation reset. Finance is holding key support, but valuation is a very significant issue here. When you look at the historical valuations of the bank stocks, they're way above it. So that is a key one to watch. But there are some absolute gems that are still rising. They haven't necessarily done so in the last week. But if you're looking over a period of 3 to 6 to 12 months, there are some gems that are still doing extremely well. Let's go and look at those charts before we deal with precious metals. So this is the ASX 200 on a daily chart. So it's been a pretty consistently negative couple of weeks, and we're almost down to the 200-day moving average. Huge volumes in the index on Friday. That's materials on a weekly chart. This is 200-week moving average, and we've really been trading under it for most of the last 8 months or so. So that's all pretty negative. And with the signs around iron ore and the impact that that's going to have on the BHPs and the Rios and Fortescue stocks, it's hard to see the index doing much else really. And I talked about that going back about 3 months. I think at the end of 2024, I was talking about the fact that the ASX 200 would really have to struggle from here. There is the information technology, but that was a fair bit about Tech Global, so I'm not terribly concerned about that sector. Healthcare has just been sideways for a while. There's finance on a weekly chart. This is a key level. This needs to hold, and from a valuation perspective, really, it shouldn't hold. The prices really should go down. And finally, this is energy on a weekly chart, and it's been heading down now for quite some time. Let's just check the currencies. There's the US dollar. We'd been declining for a number of weeks, but we did have a nice turnaround last week, and that particularly torpedoed the Australian dollar, and we finished. You'd have to say that we're still in the mode where we're getting lower highs and lower lows, and the likelihood that this key support level breaks around 61.3 is quite significant. And that's not going to be good for the Australian economy and inflation. So that's where we sit with all that. Let's take a look at silver and gold, precious metals, and also Bitcoin. Weekly chart. So we had several weeks, in fact, we had 6 or 7 really positive weeks for silver. Last week certainly did some damage and is typical of how things work with silver. Taking the stairs on the way up and the elevator on the way down, comes back far more quickly. There's the gold chart, but that's still really positive. It's not that significant. In fact, last week was less significant than these weeks back here in early to mid-November. So that's still very positive. When we look at the Australian dollar, because the Australian dollar fell, the price in Australian dollars was pretty much unchanged. And we finished at just still over 46.05. So still extremely profitable territory for the Australian gold producers. All right, this is Bitcoin. Had a significantly poor week and actually at one stage went down below 80,000. Had a rebound on Friday, managed to close at 84 and a bit, but that's certainly been a significant break of the support around about 90,000. So just to summarize, gold was down $76 to 28.58 in Australian dollars, 46.05. I haven't amended that. Silver was back to 31.13. So the 8-week streak to the upside in gold has finished. Combination of US dollar strength, but that has been playing less of a role than it often does because we've had US dollar strength and we've had a rising gold price over many periods in the last year. I think the tariff uncertainty and what that might do to inflation is certainly not helping. And 8 weeks up in a row is pretty amazing for any commodity. So we'll excuse gold if it had a week to the downside. I don't think it signals any sort of change of trend. If we look at the local miners, they took the opportunity to take a bit of a breather. There's no trend change there at this point in time. Bitcoin, it depends on the time frame you're looking at. In the shorter to medium term, we've had a significant break of support, no question about that. So we're in a corrective phase, and Bitcoin doesn't do things by halves. The corrective phases are big and they're disruptive. But I guess anyone that's been in Bitcoin for the long term knows that and can accommodate that. It was down 7% for the week. At one stage, it dipped under 80,000. There were big ETF outflows as well, but that's normal. That's the panic reaction. That's part of the liquidation process. The volatility is well beyond the norm of what we get elsewhere, and that's why it can be such a difficult journey. But if you step back and take a big picture view, and I'm talking 5 to 10 years, Bitcoin keeps setting new all-time highs. So it depends on your time frame and what you're in it for. So that's the key point with Bitcoin. And I'm new to the Bitcoin party. I was a skeptic only 12 months ago, and I don't get down in the weeds. And I've had some people send me stuff, and they're all over Bitcoin. They know it intimately, and that's fantastic. And I'd admit they know far more about it than I do. But what I do find is a constant theme of they're really getting down in the weeds of fundamental analysis about why Bitcoin is doing this or why it should do that. I just find all that too hard to grasp, and I just look at the big picture, and that is we've got fixed supply and we've got rising demand. So if you're in this for the long term, which I think with something as volatile as this, you have to be, that has to be the way you're thinking, then it's pretty simple. It's setting new all-time highs. Sometimes it goes down a lot. So it's not for the faint-hearted, but that's the nature of Bitcoin. When is the best time to buy? Not only Bitcoin, but other really volatile stocks. It's when the mob turns against it. And I suspect there's quite a bit more than normal negative rhetoric around Bitcoin at the moment. So it may get more negative yet, but the mob is certainly not positive on Bitcoin anymore. Keep it simple, keep it gradual, don't make big moves, don't buy and sell large exposures to Bitcoins, just not smart. Use the cycles to advantage. We're definitely in a negative sentiment cycle, so use that to advantage. But in saying that, this may not be the bottom yet. And it's a big picture play. That's how you need to think about it. And in one sense, you could almost think about it as an anti-Trump, anti-Musk play. I'm not sure if that's valid, but that thought popped into my head a couple of days ago. So that's Bitcoin. Other commodities, copper, 453, unchanged, same or very similar with nickel. Copper tariffs are now in focus. I've been saying that copper was holding up well because tariffs were not in focus. Well, Trump got around to it in the end. He's probably going to get around to slapping tariffs on most things. Hasn't disrupted the copper price as yet, but American foreign policy is such a dog's breakfast, and that is a big commodity issue. When you don't know what's going to get hit next and what that might do to supply chains and what that might do to supply and demand and economic health, then it's rarely going to be good for commodities. So there's no question we're in a difficult period. West Texas Intermediate crude was lower, broke 70, which is a key band. Let's not get too excited because it broke a specific level, but it's certainly under pressure, that's for sure. And it's just caught up in this whole US foreign policy mess. There are certainly some positives that Trump has brought to the table, but very unfortunately in the last couple of weeks, he has done some things that I think are losing him support, which is unfortunate because there are many good things for the long term that are underway. But he's made pretty much a hash of the last couple of weeks unless he has an agenda that none of us can grasp at this stage. So wrapping it all up, final thoughts. There's really only one way to navigate this phase of we've got a change of character. We might be going sideways. We might be going down. We don't know at this stage. So what do? You don't want to wait until the market broadsides you to discover that it's going down. So there's only one way to do this. And the one way that you can't do it is make it up as you go, just making emotional gut feel decisions. That doesn't work. The inevitable consequence of that is that you'll sell things at very inappropriate times. You'll hang on and you'll hang on and you'll hang on, and the pressure will get too great for you and you'll sell it. And that'll generally be pretty close to the lows. That's most people's experience. So you can't make it up as you go, looking to sell perhaps when sentiment is at its worst. The volatility, which is becoming quite irrational, particularly around earnings results, is too great. The cross currents that have been caused by leverage, the forced liquidation, they're too great. These are cross currents that are meaningless for the long term, but they cause huge price movements. So you've got to be very clear about your purpose, and I talk about this every week. I do that because there's a reason. Most people aren't clear about their purpose and their process. You've just got to be clear about those things, and we spend a lot of time working on that in the Insiders Club and Portfolio Analyst. But the final message that I want to leave you with, and this is really the key thing out of where we sit at the moment, this is the sort of phase that you're in where irrational price movements occur, where one really makes their money and sets up their year, because you get to buy stocks that get sold off with the rest that shouldn't be sold off. And not only does that mean that you're entering them when there's less downside risk, because a lot of the downside risk has just been removed, the price has fallen. But secondly, it means that your upside is then so much greater. So embrace this phase. Don't fear this phase. It can really work dramatically in your favour, but you've got to be organised. Portfolio Analyst this week is taking stock of the month of February. It'll be a educational process, but it will also be a continual progressive reassessment of what I'm seeing in the market. All right, that's it for this week. There's more information on the website. There's my email address, and I just can't see how the week coming is not going to be as significant as the last two that we've just gone through. So enjoy it, and I'll be back with you next Sunday. Cheers.